Modern portfolio theory uses a risk measure based on the standard deviation or the variance. But there's a lot of discussion about using alternative risk measures, because in certain cases the standard deviation of the variance of returns or market values may not be appropriate. For example, you may not want to use the variance if the probability distribution of either returns or market values is not normal, if it's asymmetric, because basically then the variance or the standard deviation doesn't do a good job in terms of picking up the risk. Remember that a normal distribution can be characterized by two things, the mean and the standard deviation. As soon as you move to asymmetric probability distributions, then you have to worry about what we call higher order moments, things like skewness or kurtosis. So in that case, we may want to either use different risk measures or supplement the variance as a risk measure. Another reason we may not want to use the variance is if we have a large percentage of the values in the negative range. Basically, here prospect theory comes in. For example, if investors are not totally rational and they exhibit certain behavioral characteristics, then one has problems, and I'll come back how prospect theory fits into this. One alternative risk measure is to look at tracking error, TE, tracking error. So it's a change in the return standard deviation, where what we're doing is we're looking at the return on the portfolio in relationship to the return on a benchmark, and the benchmark could either be a market index or a style index. So it's looking at deviations in the return. So now what we're going to do is we're going to look at the two major asset classes in terms of what is the tracking error for stocks, and then we'll look at bonds. So if you look at stocks, one way of getting a good measure of tracking error is if we assume that returns on the portfolio are related to the return on the market using, for example, the CAPM type of relationship. So basically what we have here is a return on the security is the sensitivity to the return on the market plus an error term. And generally, I've assumed that this is in terms of excess return, so I don't have to worry about the intercept. So the variance of return is going to be the beta squared times the variance of the market. Okay, so that comes from the systematic part of the return. So that's going to be the systematic part of risk. And the second term in terms of the variance of return is based on the variance of the error term. So that's the non-systematic part, or the part of return that in a well-diversified portfolio, for example, at the limit, the market, that part of the variance is going to be zero. So we have a systematic part to the variance and a non-systematic part. So what does this mean in terms of tracking error? Remember, tracking error is in terms of the return of the portfolio in relationship to the return of the benchmark. And in this case, I've assumed that the benchmark is the market return. So basically, if you had the same beta as the market, if you had a beta of 1, then there would be no tracking error from the first term in terms of the variance. But the portfolio may have a beta different than 1. It might be more risky than the market in the sense that it has a beta above 1, or it could be less risky than the market in the sense that it has a beta less than 1. So here we're picking up the beta difference of the portfolio that we're tracking the error for in relationship to the market. So we would use the actual beta of the portfolio we're tracking minus the beta of the market, which by definition is equal to 1. So that's why we have beta I minus 1 all squared for this term here. And then that's going to be multiplied by the variance of the market. So again, same beta as the market, then we'd have 1 minus 1, which is 0. 0 squared times anything would be 0. So the only tracking error you could get is in terms of this second term here. Okay, so again, remember that this is a variance measure. So basically, the tracking error is much like a standard deviation. So that's why we take the square root of what's in the brackets. We use a similar sort of procedure for bonds. Again, we assume that bond returns, and what I've done here is looked at if you use a total return sort of index for bonds or bond portfolios. So it's going to be the change in price divided by the initial price. Okay, so the change in value. That's going to be equal to, remember, returns and changes in rates going to move in opposite directions. So that's why we have minus the modified duration times this part here. Where does this part come from? Well, it comes from a similar type of relationship as we have for stock, a factor model. So we have the sensitivity of bond yields to changes in rates in the market plus an error term. So it's quite similar. So just like in the equity case, we should get a similar sort of relationship for the variance of return in terms of this bond portfolio. So you can see that an important aspect here is this modified duration. So again, remember this is a variance type of term, so we have the modified duration squared times the systematic part in terms of the variability on the bond portfolio plus the non-systematic part. Okay, so again, just like in the stock case, the systematic part is the beta, the sensitivity to yield changes squared times the variance of changes in yields. And then we have the second term comes from the non-systematic part of the factor model. Again, it's the variance of the error terms. So moving from the portfolio to incorporating the benchmark, because again, in the bond case, just like the stock case, we're looking at the differences in returns on the bond portfolio versus the returns on the benchmark. Okay, so you can see that here what we have is we're going to have to incorporate the differences between the duration on the portfolio times its sensitivity to changes in rates minus the duration of the benchmark. And here I've used a market index for the bond. Okay, so it's sort of a modified duration interest rate sensitivity relative to the duration on the index. So all of that is squared times the variance of changes in yields on the bond index. So again, you can see that that comes from this part of the variance of the portfolio. Okay, so all I've done is I've incorporated the fact that the index itself will have a certain duration.